Welcome to our episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Gary Jonas. Gary focuses on urban revitalization in Philadelphia by transforming blighted properties into thriving assets. He oversees a portfolio of 1,500 units, leads a team dedicated to maximizing investment value, and actively seeks partners for their new development projects. Gary, thank you so much for being on the show today.
My pleasure. Thanks for having me, Charles.
So before we get into what you've got going on now with the Howe Group, can you tell us a little bit about yourself, both personally and professionally, that led you into what you're doing now?
Sure. Personally, I born and raised in Philadelphia. Went to college, 16 years of Catholic school. And when I graduated from school, I had no idea what I wanted to do. And I happened to get into the mortgage business, by accident. And from there, what I realized was that you either had to have a really high level of education in order to make real money, or you had to own real estate. And then that led me down the path to real estate. So that's professionally kind of how that worked. And I can walk you through the timeline of kind of working for other people and then going to running our own company, which we've done for about 30 years. And then personally, I am one of 3 children. I have 2 sisters. I am right in the middle. I've been married for 26 years and have 2 girls that are 19 and 17.
Oh, fantastic. So how did, sometimes you have like ancillary real estate careers that people, maybe they're brokers or they're doing something that's active, then they get into real estate investing. How did that experience from the mortgage business really carry over to becoming a real estate entrepreneur? And obviously it gave you the realization that you need to really own real estate. But can you walk us through a little bit about what changed and how you've utilized that experience into what you're doing now?
Sure. So the first thing that changed for me was I was in the mortgage business and I read Rich Dad, Poor Dad. And when I read that, I came up with this brilliant plan, which was I am going to buy 10 houses. I'm going to pay them off by the time I'm 45, and I'm going to have cash flow coming in and I'm going to retire. That was my, plan. So I was working in the mortgage business. It was a good business. We were making some money. I was able to go out and buy 10 single family houses. And I thought, man, this plan's right on track. This is fabulous. And then I paid the first one off and I went into the house and I'm like, man, I got to do $50,000 or $60,000 worth of work to this house because I've owned it for 10 years and it, now needs some work and I'm going to have to put all this money back into it. And then I know me, I'm going to want to pay that off quick and I'm never going to get to the spot where these single family properties are actually making me money.
Yeah.
So what I did was I said, all right, well, we need a different plan for that. Now, exactly what happens at that time is we're in the mortgage business. We're doing great. We have, we tried to create a call center, because we came from a call center environment. So me and 3 guys went out, we started our own company. We tried to create this call center. We had 100 people working for us. No. And we realized we weren't making any more money than we were when we had 3 people working in the basement together. We were just doing our own loans. So we decided that our business model was broken. And we started trying to get loan officers into real estate offices. And when we did that, all of a sudden we started making money getting mortgage. So we're making some money over there. I own these 10 properties. And then financial crisis happens in 2008. We are lending our own money out. And we get a call from a good friend. And he's like, look, you better find a new platform because where you get your money from to lend out to people, they're not going to give it to you anymore just because the industry is going insane. So in a week, we were able to get a bank to allow us to operate off of their platform. And I had nothing to do because they did all the work that I did. So my partners and I said, okay, well, why don't you go out and try and buy a real estate? So luckily what happened is I owned these 10 properties. They had some equity in it. And at the time, you could get lines of credit, second mortgage lines of credit against investment real estate. So we went out and got, $1 million in lines of credit against that real estate. And we started buying more real estate. And that kind of set us on the path to, a 2-unit building, to a 4-unit building, to a 6-unit building. And then all of a sudden you turn around and you got 1,500 units.
Yeah, that was quite an exciting time. I started investing in multifamily in '06, and bought first property end of '06, bought second property end of '08, completely different times, bought another one in end of '09, and all three very different vibes of what was going on there. So just getting lending, even in on any type of property, I had issues with it. You know what I mean? It was a very difficult time. I was new to the business, but I had a commercial property I was trying to get financing for, one of those throughout that little time span there, and it was it was a no-go. I mean, it was, and you had private lenders that were like, oh yeah, like 50% will loan you on like the appraised value or whatever. And listen, no one knew what was going to happen. You know what I mean? In hindsight. So it was great that you're able to pull that much money off your properties.
Yeah, we got really lucky. And then we also got really lucky because, in the beginning, you're doing everything yourself. So we had an apartment building. It was a 3-unit apartment building. And one of the units, it would constantly have a leak in it. And so the tenant called me one day and I go down there and I have no idea what I'm doing, but I just start cutting holes in the ceiling, like trying to identify where this water is coming from. And after a half hour cutting holes all through the ceiling, I found the leak, which was exciting. But more importantly, she said to me, like, hey, you should meet my boyfriend. Like, he's in commercial real estate. And he took us from, hey, how, like, all we knew was the residential market. We knew how to finance stuff residentially. We didn't know anything about commercial financing, which quite honestly is way easier and way more flexible if you know what you're doing in that space.
Scalable too. Yeah.
Correct. So as soon as we met him and realized, hey man, if we do a really good job, we're going to be able to get our cash back out of this deal quickly, where, on a residential deal, it doesn't matter. If you do a really good job, you got to wait a year before you can get it reappraised and they'll give you another value of this. As soon as it was done, they looked at the income and they said, okay, if the building makes this much money, we'll give you this much. And it really changed the way we were able to operate the business.
Yeah, that's great. That's one of those things I found is specifically with like local banks and credit unions, if you find one that has the appetite for commercial apartment buildings, they'll loan a lot on it and they'll bend over backwards trying to get those loans. You know what I mean? You'll know because if you don't follow up with someone, they'll be following up with you and following up with you because they want that. They want your property in their portfolio of loans. So that's great. That's awesome to hear. So how did they kind of grow? Can you give us like an overview really of your current investment strategy now at the Howe Group, what you guys are doing, and kind of how that's involved from buying 3-family properties, which is how I started too.
Yeah. So, I mean, I always tell everybody when you go from one step in the process to the next step in the process, just partner with somebody on the first deal that's already done it. Mm-hmm. Especially if you're bringing value. You found a deal, you think it works. So our big leap was we went from duplexes to a 6-unit building. And we're like, wow, this financing is different. Everything is different. And when that project worked out, we started looking for sites that were a little bigger, and we found this warehouse, but it was going from 6 units to 34 units. And we were like, man, we've never done that before. So we started, asking around, and we found a guy that was a well-seasoned guy that was looking for a project, and he partnered with us and took us through the process. And we were like, okay, great. So we got through the 34 unit building with him. And then we felt confident that we could kind of build in that 30 to 50 unit space. At the time, our business model was buy on the edge of where the development currently is, build, so don't buy an existing asset, build something new, build really, really nice apartments that are maybe a little bigger, that are very well thought out with no amenities, and charge a little below the market rent and see if that works. And that works great for us. And that was our model until about 3 years ago. And so we just started there. And I don't think we've ever done anything. So we went from 30 units to a bunch of 50-unit buildings. And we kind of stayed in that space for a while. And then eventually we did a 100-unit building and a 150-unit building. But we haven't done anything outside of that size. Like it just kind of naturally went there. But what's happened is if you were buying 3 years ago or 4 years ago, you didn't know you were buying into the top of the market again. You didn't know that you were buying into interest rates doubling, supply chain issues, construction costs being more than it was in the past, right? So that was a recipe for some really tough stuff. And most people, we're seeing a lot of opportunity right now because the banks are finally starting to say, hey, we can't hold on to these assets and give people time, hope rates are going to go down, and now assets that weren't leveraged properties are going to start hitting the market. But, we were not immune to that. One of the things that we did, Charles, that was kind of part of our model was we never took interest rate risk. So when those rates went up and doubled, we were protected against that the whole time. Because we knew, like, our theory basically was take as many of the variables that can cause trouble for you out of the equation. So one's interest rate, one's construction cost, and the third is what can I rent these units for when they're done, right? We took interest rate out of the process. We started building for ourselves. Like, over time, my partner got really good at doing the construction piece of it. So we started running a construction company. So we felt like those two variables we could take out. And then that left us with just, hey, did we underwrite the market rents properly? And if we did, we would be okay. And that's what we did. That said, we, even owning our own construction company, supply chain issues and cost of materials going up really made us still lose money in our operating companies over the last 3 years. But because for 15 years, we always put a bunch of money in reserves, knowing that there was going to be a day. You never know when you're buying into the bad part of the market until it's too late, right? And if you're a growing company, and of course, we're doing the most amount of business we ever did as we buy into that market, we lost 70% of the reserves that we built up in 3 years. But we never went back to an investor and asked for money. We never gave a set of keys back to the bank. So I say to all of my investors, hey, look, my job is to outperform the sector we're in. So the sector we're in did very poorly the last 3 years. In fact, a lot of people lost all their money if they put it in there. You were expecting to make 10, 12% cash on your money, and you're making 6%. Well, that's a pretty good outcome in relation to the way the rest of the market went. And those people are receiving that message and still investing with us. So, nobody's immune to buy into a bad market. And so I feel really bad for the people that started in the last 3 or 4 years because they didn't get a chance to build up their reserves or do any of that. And they could have done just as good a job as I did, and they're out of business. And I would just say to those people, don't be discouraged. Like, it happened, you learn from it, get back out there and go again, because the more you learn, the better off you'll be.
Yeah, definitely, for sure. One thing I want to just go back to, you talked about, and you kind of glossed over a little bit, but I'm very interested in digging in just a bit. When you went to, I think it was a 34 unit from a 6 unit, and you partnered with someone with more experience, which is great advice, especially if you're going into a heavy renovation. I think you never have done like a really heavy value add deal. Like, bring someone on that's done it so you can kind of like see what they're doing, number one, but maybe also utilize their team. Can you explain what you brought to the deal, you and your like direct partners, and then what this other more seasoned individual brought to the deal, so that it wasn't just like, oh, I found this deal, now like you do it. It's like, what did you bring? Because I feel when people hear that, they're like, oh, I'll just find a deal and just find people that, will put up all the money and do all the work. But how did you kind of form that whole and structure that deal?
Yeah, so we bought a warehouse that we essentially knocked down the warehouse, built a 34-unit building. What we brought to the table is we had the asset under contract. We put half the capital in. We signed on the debt with the partner. Now, admittedly, we probably don't get that loan without the partner. So we both signed on a debt. He was really the controlling member, though. So at the end of the day, we couldn't do anything without his okay, even though we found the deal and we put up half the capital. He, at the end of the day, put the other half of the capital in, and our construction group ran it with his oversight, right? So he would say, hey, I'm looking at what you're doing. Why are you doing this? You should do this. Hey, did you think about why you're putting your elevator here? This doesn't really make a lot of sense. And he used all his years of experience to guide us through. We didn't just give it to him and be like, hey, you do it and let us kind of sit beside you and work. We said, no, we want to try and do it. And we want you to tell us what we're doing wrong and save us from all the mistakes. So, we used a hydraulic elevator versus a different type of elevator, because he told us that That was less expensive. It had better, usability over the years. We used certain types of materials because he said to use them. He brought certain groups of his subs down because he said, hey, these guys, were a little more experienced. Your guys done 6 units buildings. They never did a 30-unit building before. So that kind of stuff. It was very collaborative through the process, but we knew at the end of the day he was in charge.
No, that's great. I think sometimes people would hear that and they would think initially that it was just, you're just handing it off. But the amount of work that you did, you put up a bunch of money, you signed on debt alongside them, and he pretty much just almost acted as an advisor or mentor, and by also signing on the debt. So he has great upside there. And then getting just the subs and the other contractors that he had. I mean, it's just that alone is worth bringing on a partner like that. You know what I mean? Because that minimizes a lot of the issues you have if you have people that are actually, they've worked with one of your partners for many years and the type of property you're trying to build.
That's right. And every step up the ladder, like, oh, I can do that. But you don't realize, you don't know what you don't know. And you never want to make a mistake on the biggest building you're doing. So my suggestion is always a partner. We did a bunch of 50-unit buildings. When we went to do our first 150-unit building, there's little nuances that are different, which is you have people on site versus not having people on site. How do you plan for them? Where do you stage them? Just questions that we wouldn't even know to ask because we've never done it before. So when we did that, we partnered again with somebody that owned a bunch of 150-unit apartment buildings, and they walked us through our first one. And then we've done 2 or 3 more since then. But what we've created, Charles, and I think is really important, and everybody, like I tell everybody, this is my sheet. I made it up. I made it up because I didn't want to negotiate with each person individually and forget what I offered one person versus a different person. So I just created a sheet that lays out the development process and assigns a percentage to each of those things. So, for example, if you sign on debt, to me, that's worth 25% of the overall deal. If you bring the equity or capital, that's worth 25% of the overall deal. If you pay for the entitlements and identify the property, that's worth 25% of the deal. So we just kind of have a sheet that goes together like that.
Yeah.
And if somebody were to call me in the same situation I was in before and say, hey, I have this deal, I want to do it with you, I send them the sheet and I say, okay, well, tell me what you want to do and tell me what you want me to do for you. And then we fill out the sheet and I say, okay, well, does this look fair to you? Here's what you're going to get. Here's what I'm going to get. There are a couple caveats that are important. If I'm going to sign on the debt, you signing on the debt doesn't really help me if you're at the lower level. So we're not taking the 25% and splitting it in half. Like if you want to sign on the debt to show a level of commitment and you take 5% of the 25%, that's fine. But if I got to sign on the debt and they're looking at my balance sheet, I can't split that with you equally, right? And like that doesn't really make sense. So there's little kind of nuances within the sheet. But at the end of the day, it's worked very well for us over the years. And I encourage anybody that's doing something and saying, hey, I want to partner with somebody else, to really identify the components of the deal and assign value to them. And then say, if I were on the other side of this deal, would I think it was fair if I got that for the other pieces? Because what you'll find is people fill out the sheet and they're like, oh, I'm going to do all this stuff. Or they waited to just the stuff that they're doing. And they don't really look at the other people's perspective. And then they're shocked when they can't find a partner that wants to do the deal with them.
Yeah. No, it's a lot of great information. I've also found from one of my mentors was telling me years back is that, bring on partners that know what their role's going to be and know how to execute it. Not that they're bringing on and like training them. And you're like, oh, that makes perfect sense. But years back, I made a mistake with that of bringing someone on and I was like actually training and you're like, okay, this is just a one and done type deal. And everything worked out well, but you understand later the amount of time you spent doing that could have been spent, other parts of the project. So a lot of great information. I like that. And it also weeds out people pretty quickly when they're like, I can't provide this. I can't provide this. I can't provide that. Okay, maybe this isn't working with Gary is not what's all going to work out for us.
Exactly. In which case you just identified a deal. And it's like, hey, I'm basically getting the real estate commission for identifying a deal. Now I can negotiate it to be a little higher because I'm not regulated by that industry, but essentially that's what you've done, right? You found a deal and that's worth something.
So Gary, how does being focused on one market kind of give you and your firm a competitive edge, maybe over other guys out there trying to do similar to what you're up to?
So it's an interesting question, because one of the things, Charles, that we've done is we've said, hey, we don't want to be concentrated. Philadelphia is a big market, right? So we were like, hey, we don't want to be concentrated in one sub-market. So we would do like 1 or 2 deals in a neighborhood, and then we would do 1 or 2 deals in another neighborhood. And my initial theory was, hey, look, I don't want to be over-concentrated in one neighborhood and that neighborhood goes south, and now I got a problem. In hindsight, if I were doing it over again, I probably would have done that. Because the more intimate, like even just neighborhood by neighborhood, the more you understand it, it snowballs much quicker. So the guys that I've seen that dominate a sub-market, I think are doing a little better than we're doing by having a couple deals in all the different sub-markets. So while Philadelphia is a market we know, I would suggest to people that concentrating in the market is better than not concentrating in the market, because real estate is so hyper-local that not understanding the market and thinking you have it and missing one little thing can really create problems. And specifically in real estate, you do a bad deal in real estate, that could be a 10-year effort to work on that thing when you made a mistake, where, you're in another business, you make a mistake, you go, okay, we'll put that to the side. You can't put that piece of real estate to the side. You got to keep it and manage it and do everything you can until you fix the problem. So I would really say be as hyper local as you can and focus there, and you'll know the most about the neighborhood, and you'll probably do really well.
A couple things I found about being more focused in a local area is, number one, is that you know the rents really well that you can get, which is super important, because how many times you get performers from people and you're like, there's no way this person's going to get this, or this is like pie in the sky. Maybe it's possible, but like, am I going to put my money into that? I don't think so. The other thing too is that you explained earlier in our conversation was that you're pretty much on that line of gentrification, right? Is you're trying to find, right? And get right up onto it, and then kind of build properties that you can offer for the same or a little less in rent. So obviously in that situation, you have to really know exactly where that line is and like how it's moving and which way it's moving and how fast it's moving. I mean, that's like a very important part of your business strategy.
Totally agree. You hit it 100% right on the head. Now, what's interesting now is we're changing. Like, we think the fundamentals are such that building new construction doesn't make any sense anymore. So we've shifted our model to trying to find buildings where we can add value to the building, but not in your prototypical, like, hey, I'm going to go in and put a new kitchen in and I'm going to raise the rents $200, right? Like, because everybody's competing in that market. So where is there some juice that maybe you miss? So I'll give you an example of something we did on a real estate deal recently that made a tremendous impact. And when you hear it, you'll be like, oh yeah, that's totally simple. But everybody missed it. I missed it. Somebody on the team saw it and was like, hey, what if we do this? So in Philadelphia, one of the things that is in the zoning code is your number of units are really limited by how much parking you have. So Philadelphia wanted to create more density. So they're like, hey, we want at least one parking spot for every 3 units, or most places are one parking spot for every 1 unit. So what happened was, even when I do that, a lot of times I'll build more parking than the zoning requires. Because even though it's that way, like, people still got to live in the building and people want to park their cars on site. So sometimes you'll have more parking than is required by the zoning code. So we made an offer to buy a building, and that building had that situation where it had more parking than was required for the number of units. And they designed the building in a way where they put all their amenities, their gym, their, lounge and all this stuff in the best real estate in the building on like the top floor. And they had at the same time a vacant commercial space that they couldn't rent, because where you entered the building, it just wasn't very conducive to commercial space. And so the person that worked for us said, well, what if we move the gym and the lounge down into the commercial space and call it like a WeWork / hey, you can get a membership to do this gym. And we put 5 apartments in this space upstairs, and now we can rent them very easy. And just that change did 2 things, right? One, it activated a space that was unactivatable for way more in rent. But the second thing it did is, and I know you know this, sort of, about how many people know this, that people value residential real estate way more than they value commercial real estate, specifically small mom and pop things. So now I'm getting more rent, but the value of that rent is worth way more to the building value than the commercial space is. So those two little things in one building, we didn't touch one other unit. That's all we did. And we probably added $2 million in value to the building like that.
Wow.
So those are the kinds of things that we're looking for in today's market to say, hey, these buildings are out there. They're not everywhere, but they exist. We got to find these buildings.
Yeah. Very unique value add type situations and opportunities. So that's great.
Do you have money sitting in the stock market and you're worried about it? Or worse, you have money sitting at the bank, not keeping up with inflation? My name is Charles Carillo, founder and managing partner of Harborside Partners. And since 2006, I've been investing my money and my family's money into income-producing properties. These are real assets, real properties with real addresses that produce real cash flow. At Harborside Partners, we provide passive investors who love real estate with a turnkey investing solution. If you want to put your money to work in real estate but can't find deals, don't have the time to get funding, and the last thing that productive people want to do is manage real estate. We find the deals, we fund the deals, and we manage the tenants, the termites, and the properties. Partner with us at investwithharborside.com. That's investwithharborside.com. Go to investwithharborside.com. If you love real estate, you like the idea of passive income, and believe that income-producing properties will appreciate over time, go to investwithharborside.com. That's investwithharborside.com.
So being in this business for so many decades, I mean, what have you learned from your worst real estate deals?
What I learned from my worst real estate deals was I probably knew going in that I was stretching.
Yeah.
Right? But what happens is you become a deal junkie and you want to do deals. And specifically for us, like, we have an engine we need to feed. We have a bunch of people to work for, so we want to keep them busy. And what happens is sometimes you'll stretch to do a deal. And as soon as you stretch to do a deal, you're going to fight for 10 years. And that's why I say that, because eventually that deal will come back and we'll make money. Because over every 10-year given period of time, real estate has always gone up in value. So even if you got it a little wrong, it'll work itself out. You just got to do a lot of work and make no money for a period of time. Meaning any dollar that comes in, you're not taking any of it. You're giving it to your investors because that's the right thing to do. Because you brought them into a deal, you stretched a little bit, and now you got to pay for that. And the way you pay for that is working for free. What I see happen when people get in trouble is they can't afford to work for free on a deal, and then the deal goes sideways. So if you know you're stretching on a deal, you can do that, but only do it if you're willing, if you know I can withstand working on this one deal as part of our overall portfolio for a long period of time without making revenue. And I'm going to treat it just as nice as I treat the building that I am making revenue on, because that's what I owe to my investors.
Yeah. Yeah. That's a lot of good information there. One thing you see, if you see properties that are hugely under poor management or they're not making any money, they will go into disrepair quickly. Right. And that's where the slippery slope starts, because you're not going to get rent increases. You're not going to get people staying there. We're going to get a lot of turnover. And I mean, that starts it. And you got to have someone comes in that's really well capitalized to fix that, whether that's you sell it to someone and they do it, or you have to find another investor that comes in to assist you with it. But either way, when you're not taking care of the building, that is when all the issues, I think that's just where it really starts, and the property starts slipping, and that's where you really get into real trouble. But 10 years is a lot of time, especially if you have investors. I mean, that's a lot of time, a lot of calls, a lot of monthly updates that aren't, what you said before, what you're hoping when you purchase the property.
That's right. And generally it doesn't take 10 years, but it feels like 10 years. It might take 5 years. It feels like 10 years. The other thing I find is with our investors, if we have bad news, and everybody's going to have bad news at times, is to be honest about the bad news. Don't run from it, and explain your thought process on what you're trying to do. Because if people hear what you've done, like whenever I've had somebody complain, I get on the phone and I go, okay, well, here's what we're doing. So I'll give you an example. We built a building at the university that I went to. Okay. So we built a 200 unit or 200 bed building there. And when we built it there, freshmen lived on campus, sophomores, juniors, seniors were allowed to live off campus. Well, their enrollment went down. Then they made sophomores live on campus. Then they made juniors live on campus. And now I got this 200 bed building and all I have is seniors. Well, I can't fill the building. So what am I going to do? So I went out and started going to Section 8 and saying, hey, because there's no other real market around there, and renting the units that way. And when I went to my investors, I'm like, well, we went to these fairs and we did this, and here's our timeline to invest it. And we lent the building $100,000 so we would make sure that we covered the shortfall. We're not going to make any money for 2 years, but we'll get the building to this value and then we'll sell it because we don't want to be in this business. But here's a plan. If you have ideas or something you think is a better plan, I'm all ears. Otherwise, this is what I'm going to do. And everybody's like, yeah, that's a great plan. I appreciate the hard work. I know this sucks. Sucks for us, sucks for you, but you're being a good steward of my money. And that's all they can ask for.
Yeah. The preservation of capital is number one, right? That's how it always works in these businesses for people that have been around for many decades.
That's right.
So before we wrap up and before people learn more about your business, Gary, what advice would you have for any aspiring real estate investors out there? Maybe they're in a W-2, they're in another job, maybe like when you were in mortgages and they've got bit by the bug one way or another in real estate investing. What would you say?
I would say the number one thing is to take action. The number two thing is to understand. I used to teach a class to people at the real estate offices. And when I would teach them the class, I would always start with this idea like, hey, there's no good real estate deals out there. And Gary only gets them because he's in the business and he's getting access to deals that we don't have access to. And then I would pull up a sheet and show them. I was buying single family stuff at the time. I go, well, I bought 56% of my deals from real estate agents. So I didn't find them off the market. They were stuff that was on the market that somebody brought to me, and I just knew quickly it was a good deal and made an offer. So the first thing is, it's not that these deals only go to Charles and Gary because they're networked and nobody else is. I mean, certainly that happens on occasion, but for the most part, if you're out there hustling, you're going to find deals, right? That's number one. Number two, you got to set your expectation right. Like if your expectation is, if I find one good deal in a year when I'm getting started, that's a great outcome. And then now you got to go backwards. Well, what do I got to do to find one good deal? Well, I probably got to look at 100 different places. I probably got to make offers on 15. I probably get to the final round of 5 and I probably get 1. Like that's what the math probably looks like when you're first starting. And people look for a month. They go, man, I looked at everything. There's nothing out there. This is no good. And then they quit. And it's like, well, yeah, your expectation from day one was raw. And if you had really set an expectation and put an idea of what a funnel looks like together to bring a deal in, then you would feel better about, hey, I'm doing the work that is getting me closer to a deal. So I've looked at 50 deals. Yeah, I haven't gotten one yet, but I know that I probably got to look at 100. So I'm halfway to the goal of getting to the one that I'm going to end up with. Like that is what I would tell people. That's where I see people peter out and lose focus. Secondarily, guys like you and I, we love to talk real estate. We love to help people. Like, look at people you think are doing a good job and reach out to them and say, hey, can I shadow you for a day? You know, what could I do to add value for you? You know, is there something I can do? Can I look for deals for you? Can I work with your underwriting team? And, you know, can I run around and take pictures? Is there anything I can do for you that would make it easier for you and allow me to learn? And if you're doing one of those two things, you're probably going to be okay.
Yeah. I like the reverse engineering of the goals and the properties to look at. I had a lacrosse coach in high school, and he would say, if you're down by 2, you need 3 goals. We need like 30, 35 shots on goal, right? So you break that down to how much time's left and how, you know, and it gives you an idea, and you can utilize that in anything with you're doing with your goals that, you know exactly how many attempts you need. And then you can figure out exactly all the effort that's going to be needed. And most of the time people are like, wow, that's a lot more than I was expecting, which is how the world works. You know what I mean? So, but,
Well, I apologize, Jordan. I'd love to put one last little caveat on that though, right? So let's say you do that deal and you spend that time and that deal makes you $75,000. Well, was the work, like that's probably 5 hours a week worth of work, right? I tell people, if you're really committing 5 hours a week to doing this work, you will unearth the deal and you will make money. So now you got to just do that math, right? Same thing we did before. Okay, well, it's 5 hours a week of my time worth $75,000 or $50,000 or whatever you think you're going to make. And if the answer to that question is yes, now again you can feel good about the 5 hours you're spending because you have a pretty good sense of what the end of the road looks like.
Yeah. I think it's a little bit more difficult for people that might be in a W-2 mindset where they've been trading time for money, and to get out of that is a very difficult thing to break. And I think when people break it and then, they get that first check, I think it really plants, this can work, and they go a little bit more full throttle into it. So, Gary, how can our listeners learn more about you and your business?
Great question. They could just go to our website, which is thehalgroup.com, and just kind of look at what we're doing. We do development, we do construction, and we do property management. We try and control all three phases because it makes it, easier for us. And I always tell everybody, by doing that, if you invest in money with me and you have a question, like I can't go, oh, well, my property manager stinks, or I can't go, oh, the construction guy stinks. Like I'm your point person. So there's an issue, you can call me, I'm going to be able to give you an answer. And so, everybody has direct contact to me. You can see what we're doing on that website. We're starting to expand. Right now, our property management is one of the things that we think is underutilized. People don't do a great job of managing below the institutional level of the big 150, 200 unit buildings. So we're focusing on growing that business right now and adding existing assets to our platform. That's kind of what we're doing right now.
Fantastic. Well, thank you so much for coming on today. I'll put the link to your show, to your company in our show notes, and looking forward to connecting with you here in the near future.
Awesome. Thank you so much for having me. Appreciate it.
Thank you.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate, but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.